Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. SunPower reported earnings this week, and this is a company I've held for a very long time, been through a lot of ebbs and flows, and it seems like the market is really down for SunPower. Its operations are getting a little bit worse. Investors were actually expecting that because they did give preliminary results recently, so kind of gave a warning that results from the second quarter weren't going to be all that good. But there was some interesting information in the second quarter earnings report and presentation. So that's what I want to dig into today. And we can try to figure out what exactly things are going to look like in the future. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you like this video, check out my newsletter, Asymmetric Investing, in the show notes. And I'll just go straight to the presentation. These are the highlights for the second quarter. And one of the reasons I'm starting with this is I want to compare it to the first quarter, so 3 months ago. You can see here that there was 20,400 customers added in the second quarter, up 3% year over year, and 20,000 customers in the backlog. The other number to keep in mind is $1,000 in adjusted EBITDA per customer. What did things look like in the first quarter? Well, they were all better. 21,000 customers added, 23,000 in backlog, and adjusted EBITDA per customer was $1,200. The one thing that did get significantly better, if we go back to the second quarter numbers, is this SunVault number. This is SunPower's energy storage business. And in California, there was a change from net energy metering 2.0 to 3.0 that should give a big incentive for customers to go with energy storage. So SunVault had a 49% attach rate in California through the direct channel. In the first quarter, that number was only about 20%. That is an incremental positive long term that should be more revenue and more margin per customer, but you can see that overall the numbers are a little bit worse in the second quarter than the first quarter. I'll also get to the impact that that has on guidance. Management had some pretty aggressive guidance after the first quarter, and that's really been pulled back. Here's those new customer numbers. You can see that SunPower is still growing year over year. I do think that's worth noting. This is not a business that's really in decline, but the trends are not nearly as positive as they were previously. The old guidance was for 90 to 100,000 new customers in the year. Now that's only going to be 70 to 90,000. So we can still expect these numbers to be about 20,000 per quarter on a revenue basis. You can see that revenue is up both and year over year. But like I said, not as big an increase as management previously expected. Here's some of the explanation for the guidance. The one thing I wanted to highlight is that cash from operations is expected to improve in the second half of the year, with plans for inventory reduction, continued expansion in financing capacity, and liquidity in place. This inventory reduction piece is something that has had cascading impacts across the industry. If you follow Enphase and SolarEdge, you will notice that they actually have pretty weak guidance for the third quarter, and that's because inventory has been building at their customers like SunPower, who are not seeing sell-through or demand from end customers in the way that they anticipated. So inventory has been building at installers, and that's something that is going to impact suppliers in the third quarter. So should be a slight. So inventory is something to keep an eye on across the industry. Here's a bigger look at the full year guidance. You can see the reductions here in the number of installations or customers added, a reduction in the EBITDA or adjusted EBITDA per customer. That was a really big drop. So obviously pricing, there's a lot of pressure there. And then platform investment, which is an investment in the underlying technology platform that the company is building, that's being reduced as a result of some of these weaker guidance numbers. Overall, keeping the 2025 target model, and then adjusted EBITDA is the other one to look at. Big reduction, which you would anticipate with both lower customer numbers and then lower adjusted EBITDA per customer. And then the last thing I want to highlight here is just the trend in electricity prices, because SunPower and other solar installers are ultimately competing with electricity prices from the utility. And this is one of the reasons that demand has really dropped. As interest rates have risen, it's made it more expensive to go solar. Now, electricity prices are going up as well, but not at the same pace. So that's created a headwind long term that should abate a little bit as interest rates steady and the price of electricity likely continues to rise. We may also see some cost reductions for some companies like SunPower as they're able to put a little bit more pressure on their customers. But this is the general trend here. You can see that overall electricity prices nationwide are up 8%. There are some states where prices are up 35%. So this is mostly in the Northeast, but Nevada is up big. Virginia, Illinois, Montana up 14.5%. So there are some big increases in electricity prices. This is what management said was really the challenge, was that a lot of their markets that are growth markets, particularly in the southern half of the country, that cost of financing wasn't overcome by the increase in electricity prices. So a place like Texas would be an example of that, where electricity prices were up 10%, but that wasn't enough to offset the increase in financing costs. Not a lot of great news for SunPower, and that's not really all that surprising given all that we've heard from the industry. It seems like demand is down across the board for residential solar installers. That's driven by a number of factors, from higher labor costs to higher interest rates. And this is going to take some time to shake out. That's just the reality of the market right now. I don't necessarily see the conditions improving anytime soon for SunPower or the residential solar industry. I think long term, if we're thinking about 5 to 10 years from now, the tailwinds are really behind the industry. You see that with some of the energy storage increases in California, with rising electricity costs. But there's going to be a big shakeout period, and we're going to have to see how that plays out, see if management can get a little bit more margin out of the business, where there's growth, where there's opportunities to cut costs. So challenging year ahead for a lot of solar companies, including SunPower. That's why the stock has been down recently. I continue to hold shares and don't plan on selling them anytime soon. This is a long-term investment for me, but definitely an underperformer in 2023. So what did you think of the results from SunPower? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.